Good afternoon, everyone. It'll probably take a few minutes for people to find their way over here. We did a last-minute switch with the rooms, but I'd like to get started on time in respect for your time. So welcome to this month's Best Practices on the changing landscape of SR&ED, and I'd like to welcome John Sutherland, who's going to tell you more about how the changes to this program will be affecting you. John is a senior manager with Deloitte, specializing in SR&ED and the Ontario Interactive Digital Media Tax Practices. He has over 25 years of experience, including 14 years as a SR&ED tax practitioner and 8 years at the Canada Revenue Agency. John has experience in dealing with complex tax issues for corporations in a wide variety of industries, specializing not only in SR&ED and OIDMTC tax incentives, but in corporate tax compliance and planning as well. And just before we welcome John, I'd like to point out that we have a slide up that talks about our funding database, and on your way out on the registration table, you can pick up one of our Entrepreneurs Toolkit postcards. In there, you'll find access to the funding database, and you can search by industry and province. So without further ado, please join me in welcoming John. Thank you.
Well, good afternoon, everyone. It's nice to be here, and change in venue is kind of last minute. Certainly a bigger place than it was before. Makes me feel like a movie star or something. I'd like to thank the Academy. Anyway, so without further ado, we'll get started. So basically, we're going to talk about the SR&ED landscape and how things have been changing over the last few years. And so, first of all, I thought I would, Mariel gave that wonderful introduction and kind of explained what I've been doing. So I have worked actually for Deloitte for 14 years doing SR&ED and tax and digital media as well. And prior to that, I did work for CRA, and a lot of that time was spent in the SR&ED audit function. So I've kind of got both sides of see things from both sides, which is kind of an advantage. So today what I wanted to cover is basically an overview of the SR&ED practice in Canada and what we currently have, and take you through the budget updates. There's been some budget updates recently in Ontario and from the federal perspective. Want to focus on Canadian Controlled Private Corporations, or CCPCs, so we'll take a look at the implications to those entities. We'll talk about the program criteria. And we'll also take a look at some of the Ontario technology credits that people often overlook. And they're not quite as well known, but they can be actually quite beneficial. And last, we'll talk about stretching the SR&ED dollars, things you can do to improve the size of your claims and make your life easier if you should be subjected to an audit. So basically, the first thing I thought we'd talk about is the way the Canadian SR&ED practice is now, especially from the perspective of a Canadian controlled private corporation. So currently, there's two benefits. There's basically an SR&ED pooled benefit, which is a pool of your SR&ED expenditures that you can carry forward for an indefinite period of time. So it allows you to kind of smooth your income. So it is kind of a nice little feature. But the big benefit really is the investment tax credit. And currently, the investment tax credit availability for CCPCs is at 35%. And it's refundable on the first $3 million of SR&ED expenditures. There are taxable income and taxable capital limitations that you have to consider to maintain the refundability. And some of those translate into the provincial programs as well, similar sorts of rules. And anything in excess of your expenditure limit is available at 20%. And you can get a 40% refundability on that additional 20% if you meet the taxable income and taxable capital criteria or limitations. And basically what you have is everybody gets 20%. So non-CCPCs get 20% non-refundable, CCPCs get 20%, And if you meet the taxable capital and taxable income criteria, then you can get an additional 15% on that first $3 million of expenditures, and that becomes refundable. So it's a pretty nice feature and pretty essential that you maintain those limits, within those limits. And basically the limits are, it's based on your associated group of companies. So from a taxable capital perspective, where the associated group in the prior year had taxable capital of 10 million or less, you get full refundability of that expenditure limit, and at the 35%. And as your taxable capital raises from 10 million to 50 million, that expenditure limit is ground down. And as I mentioned before, the expenditure limit is what drives the refundability at the 35% level. So that at 50 million of taxable capital in the prior year, your expenditure limit is 0. As far as taxable income group, it's a similar sort of thing of the associated group, and the limits are $500,000 for your taxable income in the prior year of the associated group, and at that point, you're going to get your full expenditure limit, up to your full expenditure limit of the 3 million. As your taxable income increases from 500 to 800,000, then that expenditure limit is going to get ground down, so that at 800,000 taxable income, your expenditure limit is essentially 0. Now, there are some other benefits of the program. I mentioned the timing of the utilization of expenditures, basically your SR&ED pool. So that allows you to either take your expenditures currently as a deduction, or you can leave them in the pool for an indefinite period. You can carry it forward and use it as you see fit. So that's kind of nice, because you can then smooth your income as you may require according to your tax planning. There's also another benefit, which is the accelerated write-off. So where you have capital purchases, where you've purchased capital, typically you're going to have to include those capital purchases in your capital cost allowance pool on your tax return. And you only get a deduction for those over time based on the criteria as put out in the legislation. So you can't get it all at once. Whereas if you can claim these for SR&ED, you can claim them all in the current year. Any unused investment tax credits that you have that you can't use in the year against, either because it's not refundable or because you have no taxes to pay, can be carried forward. Carried back 3 years, forward 20 years. So that's another nice little benefit. So now I mentioned that there's been some changes due to the recent budget. And they're fairly significant, so it's worth spending some time on this. Basically, the ITC rate, the investment tax credit rate, has gone down, or will be going down after 2013. Oh, sorry, I need to go one more slide. Will be going down to 15%. So it's currently at 20% for non-CCPCs. There's a reduction in the proxy calculation amount, which I'll get to in a little bit of time, from 65% currently to 60% for 2013. And years after that, it's going down to 55%. That's basically an estimated overhead calculation. As I say, we'll get to that in a minute. Arm's length subcontract expenses will be reduced to 80% after 2012. That is from the 100% that's currently available for subcontractors that are performing SR&ED on your behalf. After 2013, there's no longer leases, no longer capital, and no longer shared use equipment that can be claimed. Now, for Canadian-controlled private corporations, the 35% rate for ITCs remains the same. However, it's going to be reduced, your benefit is going to be reduced by the reduction in the elements that you can claim. And 15% then will apply for a CCPC for any expenses in excess of the $3 million expenditure limit. So it's a fairly significant impact. And in Ontario, the range in reduction of benefit is going to be anywhere from 6% to 40%. And that's going to depend on a few things. That's going to depend on your CCPC, Canadian Controlled Private Corporation, Small Corporation status, and those are the limits that we talked about. The largest impact is going to be on the non-CCPCs, which currently have 20% ITCs that are non-refundable. And their loss is going to be 25% right off the top. Plus, they're going to lose some individual components. So for example, if you have a manufacturer with a lot of employees and capital, you're losing quite a bit, closer to the 40%. So also the impact is going to depend on your mix of employees versus contractors. So for employees, if you're claiming employees, you're going to lose 6% off the top. And for contractors that you're claiming, you're going to lose 20%. So it's another indication of how the impact is going to affect your claims. The capital component that you have is going to be also a major one, because if you have a capital intensive claim, so if you have a large manufacturer, a large corporation that, say for example, is setting up SR&ED facilities, research center, you're going to have a lot of capital. This would be things you'd be purchasing for conducting R&D in the future. Well, currently you can deduct that. That can be quite large. In the future, that's going to be gone after 2013, so you're just not going to be able to get that at all. Claimants that have purchased, for example, software. So where you are purchasing software for SR&ED, so say typically you might purchase 2 versions of the same software, one for your development environment, one for your production environment. And your development environment would be used strictly for R&D, for conducting improvements to the program. You're going to lose that. So that's fairly significant. Where you have a lot of materials, it's not going to be a huge loss. But you are still going to lose because of the percentage reduction. So the federal budget has a few other things that were promised. There's a promise to conduct a pilot project to determine the viability of formal pre-approval process. Now, this is similar to some of the provincial programs, and we'll get into those a little bit later, that have a pre-approval process. That could be beneficial. There's a promise to enhance the existing online self-assessment eligibility tool. Currently, if you go onto this SR&ED website or the CRA website, you will, under SR&ED, you will find that there is a self-assessment tool. And it poses 6 to a dozen questions about your activities, what you're doing. And based on your answers to those questions, it's going to give you some determination of whether or not you might qualify for SR&ED credits. So there's a promise to enhance that. There's a promise to make more frequent and effective use of tax alerts. Tax alerts are pronouncements by the CRA regarding policies and procedures. And the intention or the promise is to make the communication between CRA and the public a little bit better. And that should be a good thing. Also, improvement of the notice of objection process to allow for a second review. Now, currently, if you're in the midst of an SR&ED audit, there is a potential that you can ask for a second reviewer should you disagree with the current reviewer and the way that they're performing their task. That's just going to be formalized a little bit more. There's a promise to divert some of the savings from the reduced ITC percentages to direct incentives. So one of them is to make the Canadian Innovation and Commercialization Program permanent. And that program, CICP, was announced in the 2010 budget. And basically, it's designed to help companies bridge the pre-commercialization gap for innovative products and services that they have developed. And they do that by awarding contracts to entrepreneurs with these innovative ideas. And they provide some feedback and test the performance of these innovations so that it helps them proceed. And also provides information on how these entities can do business with the Canadian government. So the idea being that they could be offered to tender for government contracts. And the CICP targets really innovations in four priority areas: environment, safety and security, health, and enabling technologies. Enabling technologies are basically information technology is an example, biotechnology, and nanotechnology, 3 examples. So now we'll talk about some of the program criteria and how we determine qualifying expenditures, what qualifies, what doesn't. So first of all, let's define what is SR&ED. there is basically 3 types of eligible development: basic research, applied research, and experimental development. Basic research is work undertaken to advance scientific knowledge without a specific practical view in mind. Applied research is work undertaken to advance scientific knowledge with a specific practical purpose in mind. Experimental development, as I've noted up there, is work undertaken for the purpose of creating new or improving existing materials, devices, products, or processes. And that includes small incremental improvements. So it's basically cheaper, faster, better. And that's the bulk of the claims that are filed. At least 90% of the claims that are filed are in the experimental development area. Now, the eligibility criteria that you must consider there's basically 3 essential elements. Technological advancement has to be there. There has to be some technological uncertainties, and there must be technical content. You can consider it like a 3-legged stool. So you need all 3 legs must be there to support your SRED. So technological advancement is basically advances the understanding of scientific relations or technologies. Typically, it's a new characteristic or capability. There's going to be some knowledge gained, and there needs to be a transferability of the new knowledge. So for example, I've got a couple of examples up there. Integration of disparate technologies. So where you have 2 technologies that are not meant to work together, and you're attempting to make them work together, that could be an advance. Where you have a proprietary system or product, improvements that you make to that, such as faster, smaller footprint, efficiency, that can also be considered a technological advancement. And it's important to note, and I've put it down at the bottom of the slide, that success is not the requirement. It's the attempt to get that to advance the knowledge that's important. Technological uncertainty can occur in a couple of ways. You can either be uncertain that your goal can be achieved at all, that you can achieve that technological advance, or you could be reasonably certain that you get there, but you're not sure which alternative is the required path to get you there. And both require experimentation and analysis to get there. So some examples could be where you are exceeding known technology, exceeding state of the art. You're not sure if it can be done. That could encompass technological uncertainty. Where you have integration of disparate technologies, same as under advancement. Where you're not sure how you're going to get there, or not sure what path, or if you can get there at all. That can be also a technological uncertainty. Unexpected problems of, for example, existing software. If you have memory leaks or lost data, stability problems, capacity problems, that can also be a technological uncertainty. Last but not least, scientific content or technological content. The work that you perform for SR&ED must be undertaken by qualified people. And qualified people doesn't necessarily mean somebody with academic credentials. It can be somebody with significant on-the-job training or work experience in a particular area. There also must be systematic investigation. So the way you get there, the activities that you do must involve systematic investigation. And basically, the development activity must incorporate systematic investigation, going from some sort of a hypothesis formulation, through testing by experimentation and analysis, to some statement of logical conclusions. And somewhere that has to be part of your process to go to achieve your technological advance. So basically, you're departing from application of proven approaches, you're using experimentation and analysis, you're doing some testing and evaluation, and you're reaching a conclusion. And that's going to be part of your scientific or technological content. So some of the examples of SR&ED activities could include technical feasibility studies that may involve the 3 legs of the stool, review of competing technologies, design, redesign, prototype build and evaluation, programming, component system and integration testing, technical documentation for if you're keeping track of your tests and your hypotheses, et cetera, and support activities undertaken directly to help resolve the uncertainties that make the SR&ED project. That can also be an eligible activity. Now, there's a few activities that are specifically excluded in the legislation. Some of these are market research, routine testing, routine data collection, social sciences or humanities, commercial production, or style changes. However, routine data collection or data collection in general can qualify if there's a couple of parameters are met. If there's a systematic approach to gathering the data, some sort of a study design, that could qualify because it's only providing the amount of data that's required for the technological uncertainty that you're looking after. So what they're trying to get away from is that if you're just gathering masses of data and using parts of it and there's no real rhyme or reason behind the data gathering, it's going to be considered a routine data collection. However, if there's a systematic way in which you've designed a process to accumulate only the data that you require, that could qualify. So some other criteria that you need to consider when you're looking at making a claim. The development must be in a field of science or technology. The work must be performed physically in Canada. The work must be performed by Canadian taxable entities, and that's either the claimant or any subcontractors that the claimant may have included on the claim that have done work on their behalf. The claim must be submitted within 18 months of the fiscal year end, and that's a hard deadline. Previously, the minister did have some discretion, if there were extenuating circumstances, to grant SR&ED claims after the 18 months. Legislation then came in a few years ago that took that opportunity away from the minister. So he no longer has that authority. So it really is a hard deadline that must be complied with. Expenditures must be paid within 6 months of the fiscal year end. So if you have some expenditures that you've claimed, but you've accrued them, but you haven't paid them by the end of the fiscal year, you have 6 months to make those payments to make the expenditures eligible and claimable. Work contracted by another Canadian entity may be subject to reduction of eligible expenditures by the amount paid. So where you have a customer and the contract wording is such that they own the R&D, then you may have to reduce the amount that you've received from them from your eligible expenditures. It's really to prevent double dipping. That's really what the idea is. So I have a graphical representation now of what SR&ED is. So basically down at point A, we have our base level knowledge. That would be the state of the art. That's where the knowledge that you have right now. Point B would be your technological or technical objective. So that's where you want to go. In order to get there, moving from A to B represents a technological advancement. So that means faster, increased yield, efficiency, performance, capabilities, things of that nature. The green line would represent your barriers, constraints, obstacles, the ways that the systems are fighting back, the way that the information you're trying to get is fighting back and preventing you from getting there, from A to B. And the way you get there is represented by the gray arrows. So that is going to be your systematic investigative procedures that you employ to move from A to B. And some of the things that you'd be doing would be some idea generation, idea selection, some prototype analysis, testing, simulation, modeling, and logical conclusions and results. And that's how you get there. And that's what the SR&ED program is really trying to fund. So a few examples here by industry. So in the software industry, improvements to customized software could be an example of SR&ED. In the manufacturing industry, where you use process improvements to reduce production time or cost, could be some eligible R&D is there as well. Consumer goods, product formulations with restricted ingredients to achieve sought specifications. So that's where you have the same results. You're trying to get the same results with different ingredients that maybe weren't meant to be put together. Pharmaceutical, biotechnology industry, improving processes to reduce material waste. Chemicals, developing customer equipment to improve process performance so that, for example, that could be improving yield. That could be an eligible example of an eligible activity. So now that we've talked a little bit about an overview of the program, what the name of the game is claiming expenditures. So let's take a look at what you can claim. Basically, you can claim expenditures for salary and wages, materials consumed and transformed, contract SR&ED expenditures, payments made to 80% after 2012, so we're going to get a bit of a drop there. Lease expenses, so for equipment that you lease for SR&ED up until 2013. Third-party payments for people performing SR&ED on the claimant's behalf, which they can exploit. Overhead, and as I mentioned before, there's two calculations for that, which we'll get into. Certain capital expenditures are eligible up until 2013. Now, any of those expenditures must be reduced by the contract payments received. And we just spoke a little bit about that, where you have a customer that is paying you to do R&D on their behalf, depending on the wording of the contract. You may have to reduce your expenditures by the amount you receive from them. Any government grants, credits, forgivable loans also reduce for the SR&ED projects, also reduce your claim. So we'll talk about overhead first. That's the reason I bring up overhead first. It's not typically in most people presentations, it's not brought up as the first item, but it has an effect on all the other items that you're going to claim. So we'll talk about that one first. Basically, each taxpayer can choose between the traditional method of calculating overhead, which is basically a calculation of your actual overhead directly attributable to the SR&ED, or you can use the proxy method. And that's an election that is a notional calculation based on 65%, which is going to be reduced in the future years, based on 65% of your directly engaged labor. So traditional is basically, as I mentioned, are the incremental costs. So you must show the direct link to all the overhead that you'll be claiming. All those incremental costs, you got to show CRA the direct link. So it's a very onerous calculation. It can be quite difficult and can be quite contentious. It's particularly effective, however, in a manufacturing environment where the overheads are very high. Or if you have contractors, such as a financial institution, where you may have a lot of contractors performing what would normally be non-eligible SR&ED work, but is incremental to the R&D. So that could be straight testing or debugging, things like that. If it's incremental to your SR&ED project, you may be able to claim it under the traditional method. The proxy method, on the other hand, as I said, is a notional calculation of overhead. It's easier because it's a straight calculation, 65% of your salary and wages, little minor adjustments to salary and wages, but basically straight calculation. A lot less controversial. It's particularly effective where you have high labor. So we have a lot of labor, and most of your SR&ED project is comprised of people doing the R&D activities. That can be a very lucrative option. So salary and wages. So we can claim employees that are directly engaged if you elect the proxy method. You can claim employees, or the cost of employees, directly attributable if you choose the traditional method. And basically that's incremental to the SR&ED. So directly engaged really is hands-on. So those are the guys that are actually doing the work. Preparing equipment, materials for experiments and analysis, things of that nature, recording measurements. That's really the hands-on. First-line supervisors are usually the limit for directly engaged. Directly attributable, on the other hand, is more of an expanded definition of that. So it includes your directly engaged labor, plus where employees are directly undertaking, supervising, or supporting the prosecution of R&D, you can claim those as well. And those are the incremental guys. Those are the guys that would not normally have been doing the work that they're doing if it were not for the R&D. There are a few other issues that you need to consider when you're talking about salary and wages, and claiming salary and wages. One is specified employees. So a specified employee is basically an employee who owns 10% or more of the shares or ownership of the company, or is dealing at non-arm's length with the company. There are some limits on what can be claimed. Related benefits. Those can be claimed in the using the traditional method. So the incremental related benefits would be things like the employer portion of EU, workman's comp, CPP, things of that nature. They're claimable under the traditional method. So materials consumed and materials transformed can both be claimed. Basically, materials are raw materials, substances, or other items that compose the body of the thing that is the SR&ED or is part of the SR&ED process. It's kind of a theoretical sort of definition, but that's what it is. And materials that are consumed are typically materials that are absorbed, broken up, basically rendered useless or valueless as a result of the SR&ED that you're performing. However, materials transformed are materials that are incorporated into the product or the SR&ED that you're doing and have some value to either the claimant or to somebody, a third-party person, be it a customer. And they are subject to an investment tax credit, ITC recapture, when the disposition occurs. We'll get into that a little bit later. Because basically, at the onset of the SR&ED project, it may not be evident that the material is either going to be consumed or will have some value at the end. So if that's the case, it's going to be claimed as materials transformed, and if it is sold at the end and has some value, then the ITC is going to be recaptured. A few things you need to note about materials. First of all, supplies are not materials. They're considered an overhead. Those are things like cleaning products, CDs, test tubes, petri dishes, things of that nature are supplies. Energy sources, fuel, electricity, oil, etc., are usually an overhead. However, they can be considered a material where they become part of the thing that is the SR&ED. So that could be an example of that would be an endothermic reaction, where the fuel, electricity, oil, etc., becomes part of the thing that is the R&D. Cost of the materials is the same for traditional or proxy. So where you've purchased materials, then the costs are going to include your laydown cost, which is your invoice cost, customs and duty, transportation costs, other acquisition costs such as storage. Those can all be included in your material purchases. Where the R&D utilizes materials that are generated internally or manufactured, typically you're going to be able to get your raw material cost plus any direct labor that's necessary to change the material to make it usable, and any commercial overhead. So that's materials manufactured would include those three. And as I said before, it's the same for proxy or for traditional. That's just what you can claim. So contract payments, 80% after 2012. Basically, a contract payment is an amount paid to a contractor for SR&ED performed on the claimant's behalf and on an arm's length basis. So, and we've talked about this a little bit before, contract payments may be eligible SR&ED expenditures for the payor. SR&ED contract payments received may reduce your eligible SR&ED expenditures if it's from a Canadian entity. And I talked a bit about that, where they're performing R&D on your behalf and they're paying you for it, and the contract is such that they own and can exploit the R&D, then you may have to reduce your eligible expenditures by those amounts you've received. Non-arm's length contracts, the SR&ED, so that's where you have two corporations and they're not dealing at arm's length. There's some association between them. The SR&ED and the ability to claim usually rests with the performer. However, there are certain costs that can be transferred under certain circumstances. So that's something that can be considered. You need to be careful of the wording of your contracts, because that's going to support the eligibility or the ability of a claimant to claim the R&D contract payments. Leases will be with us until 2013. Two types. All or substantially all leases, which is payments for leased equipment used in R&D at least 90% of the time. So where that equipment is being used, all or substantially all for R&D, you can claim the actual cost. Where the leased equipment is being used primarily, and that definition is 50% to 90% for SR&ED, you can claim 50% of the cost. Third-party payments. Third-party payments are similar to contract payments, except they're payments to certain entities which carry on SR&ED activities in Canada. Approved associations that carry on SR&ED, or approved universities, colleges, research institutes, or other similar institutions. And the intention of this legislation is really to allow the formation of a consortium to carry out broadly based pre-competitive research that's really for the public good. So there's a lot of people that can benefit from those research dollars. Typically, the taxpayer or the claimant does not control the actual SR&ED work that's performed or own the exclusive rights. So that's what makes it a little bit different than a contract payment. There must be a link between the SR&ED work performed by the consortia or the research institute and the taxpayer's business. Also, the claimant or taxpayer must gain right to use the results of the SR&ED in their business as a direct result of the payments made. Capital expenditures, as I mentioned before, that's a big change that we're going to see coming down the pipe. Basically, two types. All or substantially all, ASA, we call it equipment, and that's basically an intent test. Well, so ASA equipment is where the equipment is used at least 90% of its operating time in its expected useful life, or all or substantially all, which is 90% again, of its value is consumed in the prosecution of SR&ED in Canada. So as I say, when you are purchasing the equipment, it's the intent to use it for this that makes it eligible. Shared use equipment, that's equipment that's used primarily, which is 50% to 90% for SR&ED. Now, with shared use equipment, you get a little bit less of a claim. So you can't claim it all currently in the first year in which you purchase it, but you can claim a quarter of the capital cost over the first year. It's really from the acquisition date to the fiscal year ending after the first year from your acquisition. So it's a year and a bit. You can claim a quarter of the capital cost, and then the second term of which you can claim another capital cost is if the equipment is used at least 50% from the time you purchase until the second fiscal year ending after your purchase. So that's 2 years and a bit. So if it's used at least 50%, less than 90% over that term as well, you can claim another quarter of the capital cost. It's a little bit of a tricky concept, but it's not that bad. So we talked a little bit about ITC recapture a little bit earlier. And properties that are subject to the recapture rules include materials, all or substantially all equipment, and shared use equipment. So in the case of materials, as I mentioned before, at the outset of the project, it may not be evident that the materials are going to be used in the project will be consumed, that means rendered valueless, or will result in some value. So in that case, they're claimed as materials transformed, and when they are sold, there's an ITC recapture. It's intended to reflect the net cost of performing the SR&ED. And in the case of capital, which is the ASA capital or the shared use capital, when the piece of equipment is sold or converted to commercial use, then you're going to recapture the ITC. There's no recapture of ITCs on labor, on overhead, or on materials consumed. So now that we've looked at the SR&ED program from a federal level, there are other credits that have benefit for similar types of expenditures. And we'll take a look at those here Took a look at the 5 of those here. We have the Ontario Innovation Tax Credit, Research and Development Tax Credit, the Ontario Interactive Digital Media Tax Credit, Computer Animation Tax Credit, and the Ontario Business Research Institute Tax Credit. So the OITC, Ontario Innovation Tax Credit, or OITC for short form, is a 10% refundable tax credit for eligible SR&ED expenditures incurred in Ontario. It's available to all corporations with operations in Ontario, so you must have a permanent establishment in Ontario. It is refundable. It has similar limitations to the federal program. So you get qualified expenditures up to an expenditure limit of $3 million. So the most you can get with this credit is $300,000. The qualification for having an expenditure limit is based on the Canadian taxable income of the associated group of corporations and the worldwide taxable capital of the associated group. Now that's a little different than the federal. The federal is based on Canadian. The Ontario is based on worldwide. A couple of planning points. There is no 18-month deadline, which is nice, so you can claim it after your SRED has been filed. And contract is a little bit of an interesting twist. The contract payments from customers outside of Ontario do not necessarily reduce your OITC benefit. So unlike the federal, where you have to reduce your eligible expenditures, in this case, where it's attributable to the R&D performed in Ontario and you receive a contract payment, you may not have to reduce your Ontario Innovation Tax Credit for it. The Ontario Research and Development Tax Credit. I should have put this up there on the slide, but it is a 4.5% credit. It's non-refundable, and basically it replaces the pre-harmonization Ontario deduction for federal ITC. So before harmonization, any Ontario portion of the federal investment tax credit that you had to include in your income, you got a deduction for Ontario tax purposes. So with harmonization, that benefit was lost. So the Ontario government decided to bring in a tax credit to replace that, and that's the ORDTC. And as I say, it's 4.5%. The catch is it's considered to be government assistance, so it will reduce your ITCs on a federal level. It reduces the SRED pool, and it does attract federal and Ontario tax. The unused ORDTC can be carried back 3 years and forward 20, but you can't go back to pre-harmonization. So going forward, it's going to be years after 2009. The taxpayer can waive the non-refundable tax credit. So the advantage of that is that it's going to increase your federal refundability if you're refundable. And there is a bit of a catch in that what you're doing is trading future deductibility against your taxes for a smaller gain in current refundability, because you're going to waive the ORDTC and you'll get 35% of it in a current refund. So it depends on what kind of cash flow you're looking at. Typically, there's no effect where you have losses on your cash flow. And the beauty is it does not reduce your OITC, so you can claim the two together. The Ontario Interactive Digital Media Tax Credit. It's run by the Ontario Media Development Corporation, and it's a refundable tax credit of 40% since 2009, March 27, 2009, for non-specified products, 35% for specified products, which are fee-for-service products. Now, before 2009, before March 2009, the rates were a little bit lower, and there were some qualifications regarding small versus large corporations. But since 2009, everybody gets 40% and 35%. The eligibility is based on the product, which must be complete. You can claim up to 3 years to get your product complete. But it's based, the product must be done, must be finished. The purpose of the product must be to educate, inform, or entertain. It must be interactive. So the user must be able to determine their own experience when they're using it, when they're using the product. It has to be multimedia. So that's 2 of text, images, and or sound. It's got to be at least 2 of those. It's available to corporations as long as you're not a non-exempt corporation, as long as then any corporation can claim it. It's for work done in Ontario, and you must obtain a certificate of eligibility from the Ontario Media Development Corporation. Once you do that, then you can include the expenditures on your tax return. So basically expenditures that you can claim salary and wages, you can claim contractors, 50% before March 27, 2009, and you can claim marketing and distribution costs up to $100,000. And the marketing costs that you can claim, the time period is basically starts 24 months before the completion of the product and 12 months after launch. 50% of meals and entertainment are all that's allowed in that category. Benefits, 40%, regardless of the size of the corporation for a non-specified product, 35% for a specified product. So basically, you get 40% if you develop and market your own digital media product. 35% if you develop it for someone else, but you don't get any marketing costs. Or if you're a digital game corporation, or if you're a specialized digital game corporation, and we'll talk about that in a minute. Actually, we'll talk about that right now. So 35% credit is available for qualifying digital media game corporations. So and the eligibility is based on the incurrence of a minimum of $1 million of eligible Ontario labor costs over a 3-year period for fee-for-service work done in Ontario directly related to the development of a digital game. So it's over a 3-year period. As long as you claim $1 million, you qualify under that category. You're not required to be at arm's length with the purchaser corporation. You are with a non-specified product. You're not required to develop all or substantially all of the eligible product. With a non-specified product, you must develop at least 90%. The 35% refundable tax credit is also available to a specialized digital game corporation. And the criteria for that category is where 80% of the Ontario payroll or 90% of the annual revenues are attributable to interactive digital media game development. And you must incur a minimum of $1 million of Ontario labor expenditures in the taxation year directly attributable to the development of those games. There is an advantage. You're entitled to claim an annual application for the credit. Now, with all the other categories, your product has to be complete. This one you can claim it on an annual basis, which is great for cash flow. Once again, you're not required to be at arm's length with your purchaser, and you're not required to develop all or substantially all of the products included. You got to develop more than half. The computer animation and special effects tax credits. It's a 20% refundable credit for Ontario labor expenditures for development of computer digital animation and digital visual effects for use in television or film. Once again, it's run by the Ontario Media Development Corporation, and you need to get a certificate of eligibility. Once you do that, you can claim the expenditures on your tax return. The Ontario Business Research Institute Tax Credit. We've seen this overlooked quite a bit. This is a 20% refundable credit for SR&ED expenditures carried on through a PE in Ontario. And the payments must be made to an Ontario eligible institute. And basically, it's a similar definition to the federal. There's a list of them. And they typically include hospitals, universities, colleges, research institutes within hospitals, and nonprofit research organizations. Now, the business that's claiming these credits must be entitled to exploit the results. And it's nice because the OBR ITC is in addition to your OITC. So you don't have to reduce your OITC by this credit. So if you add the two together, you're getting 20% for the OBR ITC, 10% for your OITC, 30% credit. It's pretty lucrative. So here I've got, there's some other incentives that are not so tax-based, but are kind of networking opportunities and have other features like that, other funding opportunities. A couple of interests, the Health Technology Exchange, helping commercialize ideas into innovation, medical, and assistive technology products. Innovation Demonstration Fund, up to 50% of eligible costs to help Ontario companies with commercialization and initial demonstration of their innovative ideas. That can be a helpful one. Ontario Centers of Excellence. They kind of bring university and industries together to turn science and technology into successful business endeavors. And those are a lot of startups. Those are pretty interesting at times. Ontario Network of Excellence, a suite of programs and services from idea to market, responsive to the needs of Ontario's world-leading researchers. So again, innovative types of programs looking to help emerging technologies and businesses foster and grow. So let's talk a little bit about maximizing your claim and stretching your SR&ED dollars. Important consideration is when with agreements with suppliers and contractors. So you want to proactively review your agreements to ensure that your SR&ED tax credits are being maximized. So you want to be clear about the terms regarding performance and ownership of your SR&ED. So typical things that you want to talk about or you want to make sure that you're reviewed is the activities that are to be performed, who's going to perform them, who owns the IP, and the fact that the claimant is going to direct the R&D activities, and the restriction of rights of contractors to use the IP for their own use. That's going to help maximize your claim and make sure that you're eligible to claim those contract payments. Invoices should have a proper segregation between materials and services. Now this is going to avoid your recapture because, of course, services are not subject to recapture. You want to make sure that you track your SR&ED on a contemporaneous basis. So the things that you want to track would be things like your labor that you've spent on eligible activities, what activities were performed, analysis that you may have performed, testing, the results, and the conclusions you reached, and a chronology of activities. This is going to meet CRA's requirements, which is becoming more stringent. And this is going to help you capture additional activities, make your claims larger. Where you've purchased capital assets for SR&ED purposes, you want to make sure that the purchase requisition indicates your intent. Because that's the factor that's going to be looked at. That's the criteria that's going to be looked at for eligibility for claiming capital. And you want to ensure that the equipment is available for use by year end, because you can only claim capital equipment when it's available for use. So anyway, that's basically the R&D. And I thought maybe we'd talk a little bit about our firm and what we do and where we fit in the whole picture here. We are the largest service provider of this field in Canada and typically use an integrated team of engineers, scientists, accountants, and kind of a one-stop shop. We all kinds of different types of engagements, et cetera. But anyway, enough about that. So that concludes it. Anybody have any questions or anything that comes to mind? Or yeah.
I don't have to sing it on.
On how to work the mic? Okay.
Are
you on? Okay.
Could you comment on the role of engagement of patent lawyers if you want to protect your idea, if the patent agent is based in Canada or maybe based elsewhere? So I deal with both.
Okay, well, with respect to R&D, if you are going for a patent, you may have eligible activities, and that's an indication of eligible activities, but going for a patent does not mean that you have qualifying activities because, I mean, if you solve the technology and the patent lawyer may not have a technological input, it may not have input into the technology as it's being developed. And really, this is a program for the development of new technology. Does that answer your question?
So the expenditures of filing for a patent are not included in this?
No, I'm not, because you're not performing any eligible activities. Maybe to get to the patent stage where you have a product that can be patented,
okay,
then that may be eligible. But the patent lawyer itself, I would say no. You had a question over here?
What is the rule about the salary? Is there any limit for salary or any?
Yeah. Well, there's no limit for salaries per se unless you're a specified employee. So there are, and in that case, you're limited to 5 for your deduction pool. You're limited to 5 times your CPP pensionable amount. And for the proxy-based calculation, you're limited to 2.5 times the CPP pensionable earnings amount for that year. And you're also limited to 75% of the eligible time for the proxy calculation. So those are a couple of things where you're limited for salaries. Other than that, it's just what's paid on your T4. I mean, there are certain aspects of salary and wages which might be excluded, such as severance and things like that, or stock options and stuff like that. But as far as claiming the salaries, there's no particular limit.
So, for example, if you pay yourself a low salary in the first
Yes.
year, and then you notice that your activity is eligible for SR&ED,
Yes.
can you claim back that salary as a kind of market salary?
So you mean, have you paid it by year end? Where are you? Like, I mean, have you finished your year end and finished your books? Because when you're paying salary,
At the time you claim for SR&ED,
so you've already passed your year end.
yeah.
I don't see how you could do it because you'd have to have something that would be retroactive. You could run into that problem. So where you've paid yourself a low salary, basically CRA is looking for something that's on your T4. Maybe you've accrued a bonus at your year end and then paid it later. Well, then you could include that. But you can't go back and claim additional salary.
Okay, and 75% of that salary is eligible for...
No. It could be all eligible.
Under proxy, you mentioned?
Oh, under proxy? No. That's for the proxy calculation only if it's a specified employee, which is an employee that either owns 10% of any class of shares or is at non-arm's length with the corporation. That's only for the proxy-based calculation, 75% of the limit of time that they can spend and 2.5 times the CPP amount. For a specified employee, the maximum that you can claim for your deduction pool is going to be 5 times that CPP and pensionable amount. Only for specified employees. The rest, you're fine.
Okay. And in case you decide about the proxy method
Yes?
this year, do you have to stick with this method in the
No.
following year, or you can
Every
change?
year is different. However, when you decide that you're going to use proxy or traditional, that's it for that year. So if you file an amended return, even if you amend your R&D, you can't change that election. But every year you can make that election as you see fit. Absolutely.
Okay, thank you.
Oh, you're welcome.
I have a question regarding
Sure.
the Ontario Interactive Digital Media Tax Credit.
Sure.
So when it says interactive, how interactive is that? Is the MaRS website interactive enough? Or
Well, I'll give you an example. Magazines, games, it's games, magazines, as long as it includes those parameters of text, sound, images, text, and sound, then that's fine. I mean, and as long as the user can determine their own experience. So, for example, one video is not going to be interactive enough. If you got a bunch of videos on your website where they can choose, I'm going to watch this video, I'm going to watch that video, well, that could be eligible.
All right, great.
Okay.
Thank you.
Oh, you're welcome.
Hi, I wondered if you could expand on government assistance, how that deducts from SRED or reduces SRED,
Sure.
as specifically forgivable government loans. And is there a way
Yeah.
to structure them so that they're not included?
Yeah, sure. Basically, government assistance is going to include grants, credits, and forgivable loans. And when you're looking at the loans, in order for you not to have to reduce your SRED expenditures by a loan amount that's been given to you, it must be irrevocably payable back to the government. So in other words, the government must demand it back, and under no circumstances can that loan be forgiven. Then you don't have to include it. However, if there's any chance that it could be forgiven, you're going to have to consider that as government assistance. Anybody else? Come on. What do you think about the Kings winning the cup? No comments? Well, thanks, everybody. I appreciate your time.